SneakPrice Weekly Market Report, episode 008. The sneaker market has changed, and you might be buying the wrong sneakers. What if the sneakers you've been buying aren't the sneakers winning this market anymore? For years, Nike and Jordan dominated sneaker culture, full stop. But something has shifted. ASICS is surging, New Balance keeps growing, Saucony just exploded onto the resale scene, and Jordan, it's recovering, but selectively. So today we're asking a simple question. Are you buying the wrong sneakers? Quick disclaimer, everything here is market data and informed opinion, not financial advice. Every figure is a snapshot from when we researched it, not a live number. Let's get into it. For years, the safest formula in this market was simple. Height creates demand. Demand creates scarcity. Scarcity creates premium. That formula isn't dead, but in 22.6, height no longer guarantees value on its own. Data increasingly separates brands that are culturally loud from brands that are actually gaining ground. That gap is what this episode is about. Straight from Nike's own fiscal 2026 filing, Jordan brand revenue was $7 billion, $34 million for the year, down 3% on a reported basis and down 5% currency neutral. That's real pressure. But here's where it gets more interesting. StockX's own August 2026 report shows Jordan sales on their platform actually up 6% in the first half of the year, with average resale prices up 5%. Jordan is StockX's second largest sneaker brand. StockX's CEO Greg Schwartz put it directly, quote, Jordan is showing signs of recovery, and at the same time, interest remains diversified enough to push a name like Saucony to the top of the sneaker list, end quote. The takeaway isn't that Jordan is dead, it's that Jordan is recovering, in a market that no longer revolves around one or two brands. ASICS just reported first half 2026 results. Revenue of 534.4 billion yen, up 32.7% year over year. That's the first time the company has topped 500 billion yen in a half-year period. Operating profit came in at 120.4 billion yen, up 48.5%, pushing operating margin to 22.5%, a company record. This isn't just a TikTok trend. When people ask why, everyone's suddenly wearing ASICS. The answer is that there's real confirmed business growth underneath the cultural moment, not just cultural noise. New Balance reported $9.2 billion in global sales for 2025, up 19%, its fifth consecutive year of double-digit growth. North America grew more than 20%, Europe more than 30%. This is the clearest evidence yet that consumers aren't abandoning sneakers as a category. They're redistributing their attention across more brands than before. Here's the twist nobody saw coming. According to StockX's own August 2026 report, Saucony sales more than tripled, up 239%, officially ending ASICS's two-year run as the platform's fastest-growing sneaker brand. The Pro Grid Omni 9 and the Pro Grid Triumph 4 drove the surge. Right behind Saucony Vans, up 238%, with average resale price climbing from $102 to $180. ASICS, for its part, is still StockX's fourth largest sneaker brand overall. The platform called this more of a normalization than a collapse, not ASICS falling off. One honest caveat, because it matters for credibility. These percentages aren't measuring identical things. Sales growth, price growth, and company revenue are different metrics, and we're not implying they're directly comparable just because they're all impressive numbers. So, are you buying the wrong sneakers? Here's a simple way to think about it the same way SneakPrice's own terminal is built to help you think about it. Green zone, rising demand, tightening supply, strong sell-through, the shoes actually gaining ground. Yellow zone, strong. Brand, high release volume, but only moderate real demand. The shoes riding brand reputation more than current momentum. Red zone, falling interest, abundant supply, resale, sitting below retail. The shoes where the hype has already peaked. That's the real shift here. Knowing a sneaker is popular isn't enough anymore. You need to know what the market is actually doing underneath the popularity. This is exactly why we built the terminal the way we did. Market pulse, brand indexes, top movers, liquidity, and sneaker alpha signals all in one place. Instead of asking, is this sneaker popular? You can ask, is demand rising? Is supply tightening? Are listings actually moving? And is the resale spread worth it? Pull it together, and here's the real thesis. The sneaker market isn't moving away from Nike and Jordan. It's moving away from automatic brand loyalty. Consumers are rewarding comfort, performance, design, heritage, scarcity, and increasingly plain value. That's why ASICS, New Balance, and Saucony are gaining real attention while the traditional icons work to regain their footing. The old market ran on hype, the new one runs on data. What we know, StockX's own report frames this as diversification, not decline. Jordan is recovering, ASICS remains a top 4 seller even after losing its growth crown, and Saucony's surge is backed by 2 specific, named models rather than vague brand buzz. What we think as an informed read. Expect this multi-brand pattern to continue rather than snap back to a Nike and Jordan-dominated market, and expect more challenger brands to follow ASICS and Saucony's exact playbook. Real product wins driving resale attention, not just marketing spend. Neither is a guarantee. If you remember 3 things. 1, Jordan's brand revenue is down, but its resale demand is actually recovering. Those are 2 different stories, not one. 2, ASICS and New Balance both have real, confirmed business growth underneath their cultural moment, not just hype. 3, Saucony is, right now, the actual answer to what's the fastest growing sneaker brand, not ASICS anymore. So, are you buying the wrong sneakers? Maybe, if you're still choosing based on hype alone. Not if you're watching the actual data. Not financial advice, just what the numbers show. Subscribe for next week's report and track it all live at SneakPriceApp.com. See you next week.